90% of investors get dividend investing completely wrong. They chase the highest yields, buy whatever's paying 8 or 9%, and then wonder why their income gets slashed in half 6 months later. Meanwhile, the investors who actually build generational wealth through dividends follow a completely different playbook, one most people never learn. Here's what's wild. Since 1926, dividends have contributed roughly a third of the S&P 500's total returns. In some decades, like the 1940s and 70s, that number climbed above 50%. The investors who understand the rules I'm about to share don't just collect income, they compound it into fortunes. Quick disclaimer: I'm not a financial advisor and this isn't financial advice. Always do your own research before making any investment decisions. Today, I'm breaking down the 10 rules of dividend investing that separate the amateurs from the professionals. These aren't suggestions. These are the non-negotiables that determine whether your passive income streams grow for decades or dry up when you need them most. And rule number 7. That's the one that could save your entire portfolio from a disaster you never saw coming. Let's start with the foundation that most beginners completely ignore. Rule 1. Never chase yield. This might sound counterintuitive. You want income, so shouldn't you buy whatever pays the most? Here's the problem. When you see a stock yielding 10, 12, 15%, that's usually not a gift. It's a warning sign. Dividend yield is calculated by dividing the annual dividend by the stock price. So when a yield spikes abnormally high, it often means the stock price has collapsed. The market is telling you something is wrong. Maybe earnings are deteriorating. Maybe debt is piling up. Maybe the dividend is about to get slashed. The technical term for this is a dividend yield trap. It looks attractive on the surface, but underneath the fundamentals are crumbling. FMC Corporation learned this lesson in 2025 when their share price crashed over 60%, pushing the yield to eye-popping levels, right before they cut dividends by 86%. If a yield looks too good to be true, it probably is. Rule 2. The payout ratio is your safety net. This is where the professionals separate themselves. The payout ratio tells you what percentage of a company's earnings goes toward paying dividends. Research from Wellington Management found that the safest dividend stocks historically maintained payout ratios around 41%. Here's how to think about it. A ratio between 30 and 50% is generally considered optimal. The company is returning value to shareholders while keeping enough cash to reinvest in growth and handle downturns. Once you creep above 70%, you should start asking questions. Above 80%? That's often a red flag that the dividend could be at risk if earnings decline. The math is simple but powerful. If a company earns $1 per share and pays 50 cents in dividends, that's a 50% payout ratio. Plenty of cushion. But if they're paying 90 cents on that same dollar of earnings, there's almost no margin for error. Harry learned this the hard way. He bought a high-yield stock with a 95% payout ratio because the income looked incredible. Then earnings dipped 15% during a mild recession, and suddenly the dividend was mathematically impossible to maintain. The cut came. The stock dropped. Harry lost on both the income and the principal. Rule 3. Prioritize dividend growth over dividend yield. This is the rule that transforms your investment portfolio over time. A stock yielding 2% today might seem unimpressive compared to one yielding 5%. But if that 2% grower increases its dividend by 10% annually, something remarkable happens. Let me show you the math. Say you invest $100,000 at a 2% yield with 12% annual dividend growth. Your friend invests the same amount at a higher yield with slower growth. Initially, your friend collects more income. But fast forward 15 to 20 years, and your growing dividend stream has overtaken theirs, while your share price has likely appreciated more because companies that consistently grow dividends tend to have stronger fundamentals. Visa is a perfect example. Over the past 15 years, they've grown their dividend at a compound annual rate exceeding 20%. An investor who bought early doesn't care that the starting yield was small. Their yield on original cost has become extraordinary. Rule 4. Look for dividend aristocrats and kings. This isn't about prestige, it's about proof. Dividend aristocrats are S&P 500 companies that have increased their dividends for at least 25 consecutive years. Dividend kings have done it for 50 years or more. Currently, there are 69 aristocrats and 56 kings. Think about what that means. These companies have navigated the dot-com crash, the 2008 financial crisis, the pandemic, every major economic disruption of the past half-century, and still managed to raise their payouts year after year. Procter & Gamble has increased dividends for 69 consecutive years. Johnson & Johnson for over 60 years. These aren't lottery tickets. These are battle-tested businesses with durable competitive advantages. Does being on these lists guarantee future success? No. 3M and Leggett & Platt both cut their dividends in 2024 after decades of growth. But statistically, companies with long dividend growth streaks are far more likely to maintain that pattern than companies without one. Rule 5. Reinvest your dividends. This is where compound interest becomes your greatest ally. Dividend reinvestment, often called DRIP, means using your dividend payments to automatically purchase more shares instead of taking the cash. The effect over time is staggering. Research shows that dividend reinvestment has accounted for approximately 40% of total stock market returns historically. In some analyses, reinvested dividends contributed 75% of the S&P 500's gains over a 40-year period. Here's a real-world illustration. A $10,000 investment yielding 3% with 8% annual dividend growth, reinvested, could grow to over $90,000 in 20 years. Without reinvestment, using the same assumptions, you'd have roughly $50,000. That's nearly double your ending balance just from letting your dividends buy more shares instead of spending them. Rule 6. Diversify across sectors. This rule protects you from concentration disasters. If you load up entirely on one sector, say energy or financials, and that sector gets crushed, your income stream gets crushed with it. Smart dividend investors spread their holdings across consumer staples, healthcare, utilities, industrials, technology, and real estate. Different sectors perform differently during various economic conditions. When one area struggles, others often hold steady or even thrive. The goal isn't maximum yield from any single sector. It's durable income that survives whatever the economy throws at you. The strongest portfolio diversification strategies include at least 15 to 20 holdings across 6 or more sectors. Harry restructured his portfolio after the 2008 crisis. He'd been heavily concentrated in bank stocks, great yields until the financial system nearly collapsed. Now he caps any single sector at 20% of his holdings. His income is lower on paper, but far more resilient in practice. Rule 7. Monitor free cash flow, not just earnings. This is the rule that could save your portfolio from a dividend cut you never saw coming. Earnings can be manipulated through accounting. Free cash flow cannot. FCF represents the actual cash a company generates after capital expenditures. Dividends are paid in cash, so if a company doesn't have the cash flow to support its payout, eventual trouble is guaranteed. A company might report strong earnings while free cash flow deteriorates. That gap often precedes dividend cuts. When analyzing any dividend stock, verify that free cash flow comfortably covers the annual dividend payment. A coverage ratio of 1.5 to 2 or higher is generally considered healthy. This single metric has flagged more eventual dividend disasters than almost any other. It's the early warning system sophisticated investors rely on, while amateurs chase headline yields. Rule 8. Understand the business. Warren Buffett's circle of competence applies perfectly to dividend investing. If you don't understand how a company makes money, you won't understand when that model is under threat, until it's too late. Dividend investing rewards patience and conviction. Both require understanding. When you know a business deeply, you can distinguish temporary setbacks from permanent problems. You can hold through volatility with confidence. You can add during weakness rather than panic sell. The best dividend portfolios aren't collections of tickers. They're ownership stakes in businesses you genuinely comprehend. Consumer staples companies like Procter & Gamble are popular among dividend investors partly because their business models are straightforward. They make products people use every day regardless of economic conditions. Rule 9. Think in decades, not quarters. Dividend investing isn't a get-rich-quick strategy. It's a long-term wealth-building approach that historically has rewarded patience when risks are managed properly. The power comes from time, years and decades of compounding reinvested dividends and growing payouts. Impatience destroys dividend portfolios. Investors abandon quality positions during temporary dips. They chase whatever's hot. They tinker constantly. Every change potentially resets your compounding clock. The data is clear. Companies that have initiated dividends or consistently increased them have outperformed both the S&P 500 and dividend cutters over the past several decades. But capturing that outperformance requires holding through entire market cycles, not just the easy parts. Set your retirement planning horizon in decades. Build positions in quality companies. Let time do the heavy lifting. Rule 10. Review and rebalance, but don't overreact. The final rule balances discipline with patience. Your portfolio requires attention, but not constant intervention. Review your holdings quarterly or semi-annually. Check that payout ratios remain healthy. Verify free cash flow still covers dividends. Confirm the investment thesis remains intact. When a company legitimately deteriorates, payout ratio spiking, earnings declining, debt ballooning, act decisively. But when a stock drops 20% on temporary factors while the dividend remains secure and growing, that's often an opportunity to add, not a reason to sell. The goal is owning great businesses for long periods. Rebalancing should correct genuine problems and maintain diversification, not react to every market wiggle. Here's what most people miss about dividend investing. It's not just about the income. It's about building a portfolio that pays you more every year regardless of what stock prices do. It's about creating a rising income stream that outpaces inflation. It's about owning stakes in businesses so profitable they can afford to share their success with you quarter after quarter, decade after decade.